In the consolidated statement of financial position, it is necessary to distinguish non-controlling interests from those net assets attributable to the group and financed by shareholders' equity. Hello and welcome to Impact Tuition. We are still treating consolidated financial statements. Our discussion in this session will focus on the accounting and treatment of non-controlling interest. Before we begin, kindly like this video, subscribe to the channel, and turn on the notification bell. Thank you. Now let's begin. We have mentioned earlier in a previous video that non-controlling interest only arise in situations where subsidiaries are only partly owned. A typical example would be in a case where the parent acquires the subsidiary at 70%. So parent acquires 70% of a subsidiary. That means the remaining 30% will be attributable to the non-controlling interest. Now, how do we account for non-controlling interest? IFRS 3 allows two treatments, two ways of valuing non-controlling interest. The first is to value NCI at a proportionate share of the fair value of the subsidiary's net assets. The second is to measure NCI at the full or fair value. Right. So these are the two ways we can use to value non-controlling interest. So we'll pick an example of each and then see how non-controlling interest will be accounted for in the consolidated statement of financial position. The first example we'll be working on is in a situation where non-controlling interest is valued as a proportionate share of the subsidiary's net assets. Let's assume at the date of acquisition, the net assets of the subsidiary was made up of share capital, of 40,000 Ghana cedis. And there were reserves, retained earnings of 10,000 Ghana cedis. So together the net assets at acquisition of the subsidiary totaled 50,000 Ghana cedis. We are also told that the NCI is measured as a proportionate share of the subsidiary's net assets. So how would we calculate the NCI to include in our statement of financial position? Let's assume that the parent acquired 60% of the subsidiary's net assets. The parent acquired 60% of the subsidiary. Right. Let's compute for the NCI. It's quite easy. Non-controlling interest share of capital. NCI share of capital The question says that the parent acquired 60%. So that means the remaining 40% is attributable to NCI. So the NCI share of capital will be 40% of the share capital of 40,000. And the NCI share of retained earnings will be 40% of 10,000. %40 of 40,000 will give us 16,000, and 40% of 10,000 will give us 4,000. So the value of NCI to include in our statement of financial position will be 16,000 plus 4,000, which will equal 20,000. 20,000 is the value of NCI to include in our statement of financial position. It is that simple. So if the subsidiary had any other reserves, we would find the proportionate share of those reserves and include them in this calculation to give us the value of NCI. It's that straightforward. So this is all for NCI being valued as a proportionate share of the subsidiary's net assets. What about situations where NCI is valued at fair value? Fair value of NCI. In a situation where NCI will be fair valued, we'd be given two things. The first is the share price of the subsidiary, or to what the fair value is at the date of acquisition. So these two are required. If NCI will be fair valued, we would be given either the share price of the subsidiary at the date of acquisition or the fair value of NCI at acquisition date. And with that, we'll be able to calculate our fair value of NCI. Now we should note that in an exam situation, we will not be required to use both methods, but we will be given what to do, either to go by the fair value of NCI or value NCI as a proportionate share of net assets. With this, we bring to a close our discussion on the accounting and treatment of NCI. Please leave your comments, questions, and contributions in the comment section. Thanks for watching and see you in our next video.